Next up, experts believe a mortgage rate war could break out after the HSBC Bank is offering the first ever 5-year fixed mortgage with a rate of just 1.99%. These historic lows indicate the cost of borrowing is likely to remain low for some time, but it's not all good news. Lenders will need to cough up a 40% deposit to be eligible. Of course, it's not lenders, it's borrowers. That's my mistake. Andrew Montlake is the director of Corico Mortgage Brokers. Hello, Andrew.
Hi, how are you?
Interesting this, isn't it? That my goodness, are we starting to create another bubble here?
Well, I mean, certainly in the mortgage market, it's a very exciting time because we've never seen rates this low, and certainly the breaking of the 2% barrier for a 5-year fix is a watershed moment, really, and one that many people thought would never be seen in the UK.
Why do you think the banks are getting into this market? Is this just simple economics? Is this just demand and supply, and where the markets see? I guess I'm trying to ask, should they not be apprehensive about luring people in once again? Cheap mortgages, they'll buy properties that they can't afford if the rates go up.
Well, I mean, the whole market has shifted where affordability is concerned. So now we saw the mortgage market review come in April last year, and that's really changed the way that lenders look at borrowers. So you have to prove affordability, you have to prove your income, you have to show proof of that in terms of pay slips. There's no such thing as self-certification or non-status or any of that. And lenders also look at not just can you afford the mortgage now, they also stress test it. So they check that you can afford the mortgage if rates do go up. So they're being a lot more careful about.
But do they? So what margin would they be allowing rates to go up by? Because 2% is unrealistic over a 25-year term. We can all agree on that, right?
Yeah.
So what would they be testing? That stress test would be factoring in a rate of what rise, for example?
Well, typically at the moment they're looking at about 3% at the moment.
On top of the 2%?
On top of whatever rate that the lender will be paying at the moment. Borrower will be paying at the moment, unless
that's pretty sensible.
A 5-year fixed rate. It is sensible. If it's a 5-year fixed rate, then the rules are different because if you look at how long most people keep their average mortgage for, it's probably around about 5 years, and then they'll look to renegotiate. Don't forget that you don't necessarily just go onto the variable rate at the end of the fixed rate period. You can also always renegotiate or remortgage to another lender if your current mortgage offering is not competitive.
Yeah, but that's presuming, we can't look ahead beyond the next 5 years, can we? Beyond the fixed period if you get this fixed mortgage. And so you could be in a situation, who knows, where once you come off that fixed rate, your rate could be going up from 2% to whatever, 5%, 6%. We've seen rates like that before.
Yeah, well, we've seen rates of 15, 16%.
Exactly.
So no one's under any illusions that when you go in and get a mortgage, that's why getting professional advice is so important, that you're not just looking at, we'll borrow as much as we can now and worry about it later. That's not really the way to look at it. It's about being sensible. It's about budgeting, not just now, but for the future. And it's about just being realistic with what you can afford. And certainly the lenders have to do that now. If you go and see a professional broker, they'll go through that with you. And we are seeing that people are being more sensible. Although house prices have increased quite dramatically, there's been a sea change in the last 6-7 months where that's concerned, in terms of borrowers are no longer willing just to pay any price for a property.
So, Andrew, would you expect the rest of the banks to start to compete with this? Will there be a mortgage war now?
Well, I think there's been a mortgage war for the last 12 months, really, and this is just the latest stage in it. We saw the cost of funds go up in the last, say, 2 or 3 months, which a lot of people thought actually that was the end of it. We're not going to see rates fall again. But now we've had inflation rate at 0, and a lot of people now think there is going to be no change in bank base rate again this year. So lenders are starting to think, well, OK, we need to get more business in. The problem is that they're aiming to get this business from the same types of borrowers, those with 40% deposit, those employed people with good incomes, etc. And there are a lot of mortgage prisoners in the background who aren't getting access to these types of deals.
You're selling this as good news. I dare guess that someone who won't is Jonathan Davis, economist and wealth manager. Hello, Jonathan.
Hi, Stephen.
Andrew here selling these 5-year 2% rate fixed mortgages as good news.
Well, clearly, if you're going to be buying a home, then you want to pay as little as possible on a monthly basis. It's interesting, isn't it? Apparently, the property people and indeed the media have been telling us for the last year how the housing market is so strong, how it's powering ahead. If it's powering ahead, how come the lenders are slashing their mortgage rates to buy in business? The reason is because it's not powering ahead. It's been absolute fallacy for the last year. The housing market in much of the country
the level of house sales
is very lackluster.
Jonathan, as you well know, the level of house sales is not what dictates interest rates.
Well, actually, mortgage rates, partially it is. Because, as I say, if the housing market was so strong, if there was lots of transactions, if people were borrowing willy-nilly, then I can assure you, just like whether it's selling cars or widgets, the prices would be higher than they are. But interest rates, mortgage rates have been falling because the transactions have not been there.
Is that true, Andrew?
Now going to interest rates, the general position is that a term I've coined, we are turning Japanese. In other words, Japan for 20-odd years until recently had very low inflation, indeed deflation, and practically zero interest rates. That's what we've had for 6 years, and that's what I expect us to have for many years in the future to come. I couldn't put a number on it.
I'm not sure I'd buy the whole premise of that. I mean, I think mortgage lenders generally, even when transactions are high, they do react to the cost of funds quite simply. And if the cost of funds are a little bit lower, then generally speaking, mortgage rates go down. So yes, I agree with you in that lenders have not been getting in the amount of business that they expected since the start of this year. A lot of them set themselves pretty stiff targets, and one thing that's put a dampener on it is the uncertainty of the general election, which has caused a little bit of a slowdown. You've got questions around mansion taxes. You've got a lot of unanswered questions. So some people are starting to wait and see with what happens in the election before they buy a home. So we're seeing transaction levels, certainly mortgage transactions, have come down a bit, and lenders do react. They want a bit more competition in the market, and they put down prices accordingly. But that happens in every market, whether it's a busy market or whether it's a slow market. And lenders at the moment are reacting to the cost of funds, which are at all-time lows, so they can afford to cut rates a little bit to get more business in.
Final word to you, Jonathan.
Final word is that inflation is the lowest in 50 years. Interest rates have never been lower. Let me restate that. They've never been lower, going back to ancient Greece. The reason for that is the big picture. There's an economic malaise going on globally. Whatever is happening locally in the United Kingdom recently, I can tell you we're turning Japanese. It's a generational thing. People who are wondering whether or not they should get into the housing market, they should think very, very carefully, because if we're turning Japanese, I'll tell you what happened to house prices in Japan for 23 years, from 1989 to 2012. They went down on average 60%. So we'll see what will happen.
Jonathan, thank you. Andrew, thank you very much. The purveyor of doom. Jonathan Davis there, 25 past 10, 0500 909 693. Maybe you're trying to buy or sell a house at the moment. You can help feed into the national picture. You can pick up the phone to us on the text 85058.